Friends, in this video for I Thought Wealth, I'm going to talk to you on the topic, what's a good return? Everybody who starts investing comes with high expectations. Naturally, these high expectations reflect in how much returns they want. Return expectations tend to be exaggerated in your early years of investing. I recall a time when people thought it was very easy to double money. Today, if I said that, most people with professional experience won't readily agree. But there could be a number of people who are experiencing investing for the first time who think it's all very easy. Many even think that making money without putting in capital is easy. This is like seeing only the positive side of an issue. Remember one thing, setting investment expectations correctly does a lot of good to the person. Most importantly, he does not do more than what he should do. Doing too much can sometimes have a very harmful short-term effect, which will have a doubly harmful long-term effect. I know a lot of people are speculating out there and confusing speculation with investments. Are you a speculator? I asked a friend. He said, no, I'm investing. Then I asked him, how do you invest? He says, I buy options on a zero brokerage. The person did not even know that what he is doing is speculation and not investment. In investment, you have to put your money to work and give it time so that it performs decently. While I say decently, what is a decent return? A decent return is inflation plus 4%. If you're doing way above that, it means that you are a better risk taker or a bigger risk taker. The two are very different. A bigger risk taker just takes more risks and more risks, sometimes more risks than he should take. A better risk taker, on the other side, need not be a bigger risk taker. He can be a calculated risk taker. Many of you would have made a lot of money during this lockdown when the markets crashed during COVID. You were a better risk taker. You took risks when the valuations were in your favor. Everything was selling cheap. By doing investing and being a better risk taker, you have generated returns which are superior. What if you continue to take similar risks now? Today, you are not a better risk taker, you are a bigger risk taker. Because while a lot of positives or most of the positives have got factored into valuations, you continue to maintain the same risk outlook. When valuations are not the same or similarly in favor, you need to adapt your risk framework. Your risk outlook should change. You need to lower your risks. But that a lot of people don't do because they have made returns way superior to inflation. Let's say you made 30%, 40%, 50% in the last 6 months. You start to believe that you are capable of beating inflation similarly. That is not a sustainable expectation. You need to lower your expectations significantly because the valuations are no more in favor like they were during that phase, and that is a one-off. But however much we say this, the tendency is to congratulate ourselves, is to be proud of what we have done and to extend that pride into our current investment actions. This is something I see. Many people say that returns in the region of, let's say, 10-12% is something that doesn't excite them. So what excites them is the 30, 40, 50% return. But such risk can never sustain the excitement. In fact, it can give you a lot of trouble and anxiety if the risks become uncontrollable. The risks in the last 6 to 8 months were controllable precisely for one reason, that is, all the risks came at you in one go, and from there the environment itself started to mitigate the risks one after the another. So it was a very sudden fall and a natural comeback. But you cannot have such a risk progression in every situation, especially in the current construct. So today we don't have that kind of a luxury which we had 6 months ago. Effectively, you need to revise your approach to risk, you need to reduce your speculation, you need to make investments, put money to work and not trade mindlessly. You need to be very careful, you need to avoid loss, you need to give time for your investments, you need to be very choosy in your investment choices, and you need to accept that from here your returns will moderate. So if somebody made high returns in the last 6 months, the chances are that in the next 6 months he would not be able to sustain that, he would need to moderate that. The extent of moderation depends upon how you manage your risks. As an investor and as a manager, I believe that there is a very strong case to moderate risks, and it is better to be safe when things become as exuberant as we are seeing in the present. So, set your return expectations lower, moderate your risk. As the environmental risks keep rising and the external risks keep mounting, reduce your risk appetite and make your decisions reflect a lower risk appetite. Expect less, move towards less, but ensure that you don't lose capital. Whatever money you made in the last 6 months is a reward for the way in which you took risks. So don't make it a case where you don't hold on to those rewards and end up getting punished for how you manage risks right now. So set your expectations right, expect less, and move forward with caution and optimism. Thank you for watching this video. Do share this video with your friends who have experienced investing and who have seen what we have all seen in the last 2 years. They can also be a part of our journey with iThoughtWealth. Stay the course with iThoughtWealth. Thank you.